ERCOT is stuck to just pay because they have to procure these ancillary services every day. When ERCOT buys this, they pass on these costs to the citizens because they have to. By Bitcoin miners being there, they're able to bid the price down lower because if you just have a few bidders, the bidders can keep the price really high. And ERCOT is stuck to just pay because they have to procure these ancillary services every day. So ERCOT's just going to be stuck paying a lot. And guess who gets passed on those expenses?
Probably the miners. Would they?
Well,
the citizens.
The citizens.
Yeah.
The citizens. When ERCOT buys this, they pass on these costs to the citizens because they have to.
Yeah.
So if they can buy those for cheaper, then those cost savings are passed on to citizens. So that's really the piece. I mean, the New York Times article totally missed that. They didn't even speak to that.
Yeah, I noticed that.
So yeah, those are the two main things that we talk about.
Yeah, no, that's important. And I think what you had mentioned, as far as it really creates an opportunity for great reliability with these miners where they're able to shut off when demand is high and they can be able to storage energy and then being able to really get back on the grid or be able to mine Bitcoin when there's not as a high demand with electricity. And some of the things in the New York Times article, speaking on that you talked about that they missed, they talked about how miners are part of these called demand response programs where they're actually compensated when demand is very high, and then typically when that goes down, they actually resell electricity at a higher price. I wanted to know, is that an accurate, statement, or what are you seeing on the ground as far as with these miners when they participate in these demand response programs? Like, how exactly are they compensated? The article kind of said in certain situations they're not compensated, they can be compensated, and they kind of made it seem like it was a bad thing that they're able to be more reliable with their grid to shut off, which is an economic profitable decision to do so, but they kind of made it seem like it was something that they're able to resell at a higher value. But what are kind of your thoughts on that when you think about what's actually happening when you're working with miners, on a regular basis?
Yeah, there's a lot of nuance there that the article missed, and they were tripping over themselves and tripping over their own logic to try to paint miners in a bad light. That's pretty clear to everybody. But when you look at what the facts are, we want to shed light on the facts because the facts are going to demonstrate that the miners are positive for the grid. And here's a couple reasons why. One thing that they did not touch on is most miners don't have forward hedges. They didn't pre-purchase a block of power at a certain price for a certain a period of time. So they are simply just operating, and if they turn off and they haven't purchased ancillary services or procured those like grid balancing services, demand response services that we talked about, then they're not getting paid by the grid at all. They're just turning off because the price of power is going up. And that is a free market function of really the beauty of price signals. Price is going up. That means the grid is getting a little bit stressed. People are cranking up their ACs, miners coming down. That's what's happening for about 2/3 of the miners on the grid. Another third of Bitcoin mining in Texas does have that forward hedge. And they've taken an economic decision. They had a counterparty. They had significant amounts of collateral, and they posted that collateral and purchased a hedge, which really gives certainty to generators to be able to say, all right, we've got a hedge. We're the counterparty of this hedge. We need to be able to have this electricity. It just provides them with certainty. So those miners are able to sell back power to the grid. So if they've purchased a hedge at 3 cents per kilowatt hour and the power is 10 cents a kilowatt hour, they can sell that back. But what people don't understand is there's always the inverse of that. They can get margin called if it goes the other direction on them. So they took an economic risk, and just like Goldman Sachs, all the hedge funds that have power trading desks, they do the same thing. But they don't get excoriated in the New York Times for doing it, right?
Yeah, that's crazy.
So it is a unique thing.
Hey, it's Amy. Click over here to subscribe, click over here for more content, and we'll see you next time.